Investing for beginners, lesson 2, why does the market fluctuate? In this video, I want to convey to you about how many moving parts work together trying to achieve a common goal. The stock market is similar to a sport like football, where each team represents a company and each player on that team works towards growing and improving the team/company. But throughout the course of a season, there are many factors that a team has to overcome that they didn't foresee, like injuries, trades, illness, competitor advantages, etc., etc. These factors cause a team's stock to rise and fall based on their chances of making the Super Bowl. That example is meant to help people relate to how companies within the market work through obstacles and factors to continue to grow their business and earnings, and people decide whether to invest in them based on their risk and reward model. That, in simple terms, is why the stock market fluctuates so drastically. Now, to get into a business-specific example, let's talk about economics. So the short answer is simple economics. And simple economics, assuming normal conditions, dictates that an increase in price is equal to a supply increase and a demand decrease. And supply and demand are inversely related. So a price decrease is equal to a demand increase and a supply decrease. Also, an interesting thing to note is also people do the best they can with the information that they have under the circumstances they face. And that implies two things. It implies that people have to have the money in order to be able to invest in the market, and they can also only choose a certain stock based on the information provided to them by that company. And the long answer is that economics has many variables to consider, like the elasticity of demand, the availability of substitutes, the availability of complements, the income of consumers, and new technology. So over the next few slides, I will go over both of these principles of the simple economics of supply and demand, but also the factors of supply and demand that change the outcome of different stocks and how it causes the market to fluctuate so drastically. So now I want to go over supply and demand, and as I mentioned before, how they are inversely related. Now I want to preface this with the fact that this example is specific to the stock market, and there are a lot of different conditions and factors that lead the economy in different directions. But I just want to give you a basic overview of how economics work and a little bit of supply and demand in regard of the stock market. So, first thing you can do is create a little graph where you have price on the left and then the quantity over time on the right. And then you graph the supply line and the demand line, which, as I mentioned, are inversely related, so they're opposites. And then you can graph the equilibrium, which this is when you have a price that is satisfying the quantity that's out there and everyone is happy. So there's a decent amount of supply and there's a decent amount of demand for that quantity that is out there, and that price satisfies those conditions. But say that you increase the price of an item. That is going to cause a shift in the supply line and a shift in the amount of quantity that is out there. So the best way is to just show that if you have an increase in price, which is right here, and that equals a decrease in quantity, and you have a new equilibrium. But what that comes with is also a shift to the left in the supply line, which is essentially a decrease in the supply, but an increase in the demand. Now this makes sense because if they raise the price of something, then it's going to decrease the quantity out there because more people are going to be buying that item. But at the same time, so it's going to increase the demand for that item because the number of items out there are going to be more popular. So I hope this makes sense, but to drive the example home even further, you can think of shares or stocks as a group of apples. So say that there are 100 apples in the market, and then someone buys 25 of those apples. There's only going to be 75 apples left in the system, which is going to cause the price to go up because the 75 left are even more valuable, but there's a smaller quantity. So that drives demand up because now people want the apples because they're going lower. So then people keep buying it at a higher price. There's only 25 apples left in the system. And that's going to raise the price even more as demand keeps driving the price up higher and higher. But supply will keep going down because the quantity is a lot lower. And you can see how the reverse situation happens as well, whereas people keep selling it and adding more shares or more apples to the system, they become less and less valuable. So as I mentioned before on the last slide, that as supply goes up, demand goes down. So first you create your graph again, and then you plot the demand line and the supply line, and then once again, you put down the equilibrium. And this is always the step that you take when you do economics. You just put everything down right like this. From there, you see what the situation is. So a decrease in demand is a shift to the right, which increases the supply. So you graph that, and you tend to delimit the second thing that happened with a 1. So as you can see, D1 caused a shift, and that is because we lowered the price, which now increases the quantity in the system. As I said before with the apples, you now reduce the price because there are more apples in the system and they're not as popular, so there's not as many people demanding that product. So the last thing to show here is that actual shift in demand to the right, which is a reduction in the demand. And that's pretty much it. I hope you can understand now how the market is working, where there's an increase in supply, so that drives down the demand, but then if there's an increase in demand, there's a decrease in supply. To sum up the last two slides, because I know that they were definitely confusing and you can always re-watch them, but the biggest thing that I want you to take away from this in simple terms is that when the market is up, it simply means that there are more buyers than sellers for that day. So there's a increase in demand and a decrease in supply. There's a lot of demand for that day and a lot of people are buying. When the stock market is down, it simply means that there are more sellers than buyers. So demand is down, but the supply is up because there are now more shares in the market for people to buy. So there is a fine balance in the stock market where prices get very inflated because of such high demand and excitement that then they go back down to equilibrium and land at more reasonable prices, and then people then buy it again hoping that it's going to do well, and then it basically follows those principles back and forth. But over time, stocks continually rise every single year due to the rise of costs and the money that it takes to do things. So you can ride the market along with inflation and along with the economy to also better your profits. Because I don't think people realize that the more people that invest in the market, the better. Because as people keep growing these businesses and keep putting money into it, it only helps everyone else that is also invested. So it doesn't hurt if your friend is invested and you are invested. It's actually a lot better for the market that more and more people invest and keep growing these companies shares and stocks. So now I want to quickly go over some of those a little bit more advanced topics which aren't as important for beginners as the initial supply and demand graphs, but it's also important to help drive home the idea of all these different factors which cause fluctuation in a company's stock. So one of the big factors is the elasticity of demand. And basically that is basically deciding how much the price changes the quantity demanded. So for elastic stocks, a change from P0 to P1 creates a big change in the quantity demanded. So this is similar to cyclical stocks, where a small change in a price equates to a very big change in the quantity demanded. But on the reverse side, you have an inelastic stock where a change in the price has a small effect on the quantity demanded. And the best example for that is something like a commodity or something like gas, where even if a change in price isn't going to change someone's quantity demanded, because no matter what, people still need gas to get from point A to point B or to go to work. So as the price changes, the demand of people going to the gas station and getting gas doesn't change all that much. Now, obviously, eventually, if you create enough of a price change, people will stop going to the gas stations as much, or will cut down in driving, or will find alternative sources. But this just kind of shows how everything is beginning to work, and how the elasticity of demand works, and how it's not just as simple as drawing the demand line, but also figuring out how steep the slope is on that line and how that affects quantity. So you can't just look at one stock and just always do the same thing. You have to decide what type of stock it is. But that's why those sectors can help you, so that you can think that more inelastic stocks are ones that are in the defensive sectors, like utilities and the consumer goods and services. So I hope that that helps you further. So lastly, I want to cover a few more of those economic factors, one of which being the elasticity of demand, which we went over in the last slide. And then the availability of substitutes or alternatives, and that's essentially Coke and Pepsi, or butter and margarine. And it's kind of a cool idea, or a cool example, because say that the price of Pepsi falls, the demand for Coke will fall because people will go out and buy Pepsi. So the demand for one product can actually fall because they can substitute with another one that is cheaper. There's also this idea of the availability of complements, which is stuff that is used together, like butter and popcorn, or peanut butter and jelly. So say that the price of jelly falls, that's actually going to increase the demand in the complement, which is peanut butter. Because say people really love peanut butter and jelly sandwiches, as the price of jelly falls, they say, hey, I can buy jelly at a cheaper price, so I'm going to go out and buy more peanut butter for my sandwich. So that is the availability of complements versus the availability of substitutes, and can be important in economic terms, because as prices change on different items, it affects the economics of it in a lot of different ways. Another interesting idea is the income of consumers, and that is mostly even more applicable in the stock market, where you have these two different ideas, where normal goods will change based on the income of consumers, where the principle is normal goods equals to an income increase is equal to a demand increase for things like shoes and hats and cars. So as you make more money, the demand is higher for shoes and hats and cars and really nice items. But if it's an inferior good, then as your income goes up, The demand goes down for those items because you're not going to be using them as much. So the example is stuff like buses or beans, where you find a more expensive alternative than just eating rice and beans or something else. And then your income is going up, so the demand is down for the bus because you can drive your nice car that you just purchased. So those are really interesting factors, and that's consumer confidence and consumer buying, and that's how the economy is driven in the first place. Is the more money that consumers have, the more they go out and spend and buy, and the more that it helps our economic system. Another factor is new technology. As new technology becomes available, more and more people go out and buy that technology to enhance their lives or to enhance their existing technology. That's a big factor that is constantly developing within our economic system. And one of the last things is new information. And this is strictly an example, but say that it came out that carrots lower your risk of disease. That basically is going to help rise the increase in demand. So that's why the factors in the economy are so big when it comes to the stock market, because companies will report their earnings, and that has a big effect on the market. And that's kind of where this new information comes in, where they discover that, just like I said, carrots are a lower risk of disease. So companies that sell carrots, there's going to be a higher increase in the demand, and that's going to rise their stock price. So that pretty much sums up why the market fluctuates. I thank you for watching this video, and please continue to the next lesson.